Hello and welcome to the Monday Futures Market Outlook for February 21st, 2012. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the US dollar, and when we take a look at what's been happening, we had a little rally attempt last week, which brought in a few days of selling. We've suggested over and over again that while we're much bigger picture bullish the US dollar, we in the same regards believe that this consolidation could very well continue for the remainder of February and subsequently even into a chunk of March. Overall, we anticipate there to be a number of basing formations along these support lines. That 78.50 is a level that acts as a support, but the retracement zones lay between the 77.50 to 79 levels, and so we're going to watch how the US dollar consolidates down in these zones as the euro may attempt 133, 134 on the upside. The US dollar could very easily consolidate down to the bottom end of those ranges, but we do not anticipate a new distinct downtrend in the dollar. This will probably emerge as a buying opportunity. Next year, when we take a look at the Euro futures contract, we were talking about the fact that after a little pullback in this Euro, we were anticipating there to be even further strength higher still as the Euro continues to absorb all of this information. What this chart doesn't show is that some of that initial pop higher has already been given back, even though there was a Greece bailout that was successfully done. Ultimately now, I think the Euro has a lot of reasons why it could still stay in this upper end of the range for even again the remainder of February and into a chunk of March. But we remain pretty adamant that we don't believe the Euro has or is positioned to have any substantial strength beyond the 135, 136 levels. So even though we're looking for short-term strength here, we do believe that that will emerge as a bigger picture shorting opportunity. But again, that may still be several weeks away. Next year, I want to take a look at the 30-year Treasury bonds, and we've been trying to anticipate a 30-year Treasury bond correction, but rather instead of correcting downwards, it's been an extremely sideways consolidation. At this stage, we're going to come to a crucial moment on these 30-year Treasury bonds, as again we're coming to test that 140, 141 zone, which is more or less contained the last 4 months of price action. If at some point that 30-year Treasury bond gives out, we could see a drop temporarily down to the 134, 135 level on the downside. In the bigger picture, we respect that the primary trend of the bond market is higher, and we are simply looking for a corrective pattern within that primary trend. When anyone looks at our bigger picture forecast, we still actually have a number of scenarios that could see Treasury bonds still actually move substantially higher, and so we're not looking for a major high or anything like that, but we are looking for the potential of a move that could still test that 134, 135 handle on the downside. Next year, when we take a look at copper futures, copper made that small little tease move higher, trying to break out the other week, and almost immediately reversed. And at this stage, it spent the entire week consolidating lower, entering right into our first downside target around that 370 level on the downside. We still anticipate copper to continue to consolidate here, and eventually it more than likely will retest those highs again. So we may see copper again testing 390 to 395, probably going into the month of March. But we believe that some substantial highs in copper should start to develop along these zones, but we're not bearish copper yet, just simply don't think that there's a lot of upside in any short-term moves higher. Next year, when we talk about crude oil, there's a lot of talk in the media now with this breakout. We're identifying this flagging formation, suggesting that crude oil could, off of this flag, have a nice push higher, and we certainly have seen that here. The initial targets we have are in this 106, 108, and even 110 zones, but the highs of last year come in around the 115, 120 areas. So there is definitely room for crude oil to make some bigger moves. But really, at this stage, one thing we're going to be watching early this morning is whether or not not the bulls can actually hold on to the gains that they've made over the weekend. And so we'll be watching whether there's follow through. More than likely, we're going to be short-term profit takers into any further strength on the upside, and then we'll leave it open to see whether or not it could follow through to the highs of 2011. Next year, we'll take a look at gold futures, and gold has actually spent the better part of two weeks or more consolidating sideways as crude oil breaks higher and so on. There's definitely room for gold to try to retest overhead resistance in the 1770 to 1800. But in the bigger picture, we are not overly optimistic. Gold, there certainly is room for a short-term quick swing higher to test overhead resistance levels. So anyone that's trying to scalp $50 an ounce can certainly try to do so for some short-term upside. But we believe this overhead resistance is substantial, and gold will struggle as it approaches previous highs up along those overhead resistance lines. That brings us to want to take a look at the S&P 500, and we're going to start off with a weekly chart with an 80-week moving average, which has done a very good job to depict the bull and bear market cycles the market has gone through in the last 3 decades. And when we look at what's happened in the last year, we've had a number of false starts on either direction, and with a moving average that is distinctly pointing higher. Right now, we are definitely in a bullish signal. We have a market that's approaching its 2011 highs or has already exceeded them, and there is definitely a window open for there to be even further strength higher in the S&P 500 over the upcoming months. In the bigger picture, we don't believe that the S&P 500 is positioned for a substantial new bull market, but there's certainly room for there to be 2-3 months of further bullishness, and that could take the market to 1440, 1450 on the upside. And if things are very, very bullish, it could even go higher. But right now, we're just going to first see whether or not we can see any substantial progress above the 2011 highs. So when we take a look at that S&P 500 on the daily charts, we had definitely a push to the top end of that range. We've been drawing on the pattern that suggested that we are looking for some sort of a corrective pattern. Many of these corrections last about 5 to 10 trading sessions, and if, at least from the past, the S&P 500 pullbacks have been usually anywhere from 40 to even up to 80 S&P points during the pullback. So that would be targeting zones in the 1320 to even 1280 zones on the downside of the S&P. But in the bigger picture, that will more than likely emerge as a buying opportunity still for what a stock market should relatively stay bullish into that March and April cycle. The market correction does not necessarily have to always begin right away. There's definitely room that even for the remainder of this week and going into even next week, there could be a lot of false starts and choppy price action. And a market correction usually needs a trigger, and if there's no trigger, then the market tends to be very heavy, where rallies are distributed but there's no real selling momentum. So just because we're saying that the market is ripe for one of these corrections, it doesn't necessarily mean that this week will bring it, but we think that the risk reward of trying to be long this market without first waiting for a correction is poor. Very quickly looking at our key intermarket observations, right now in the short term, because of the dollar already being at the bottom end of the ranges, we are far more neutral and long-term bullish on that, but there's definitely, in the point of being neutral, suggesting that there is room for the dollar still to temporarily weaken and stay within this range and go to the bottom of the range and top of the range in that kind of a fashion for even another month or so. In the same regards, we are relatively neutral commodities on the short term. Just we don't believe, let's say, copper will have any big sell-off, or even gold or anything like that. And there's definitely room for things like crude oil to strengthen on the short term. But in the bigger picture, we are relatively bearish commodities. We just believe that this move has to sort of finish playing out, and therefore on the short term we're not positioned that way. We have a short-term bias looking for these bonds to correct, but we are longer-term bullish these bonds, and we remain relatively neutral to stock market. We don't believe at this juncture this market is positioned to have a substantial crash immediately, or even not necessarily even on the longer term, but there definitely is room on the short term for there to be a pullback, but we are not bearish by any means at this moment. That was your Monday futures market outlook. Thank you for joining me.